First of all, we will understand what is share-based payment. Share-based payment means an entity pays its employees or others in the form of shares rather than cash. So instead of paying salary to your employee, let's say you are giving him shares of your company. So that's called share-based payment. Okay, so here the company will recognize the expense related to those shares, and the employee will recognize a financial asset representing the right to receive those shares. Now, before we were recognizing the share-based payments under the fair value-based method and under the intrinsic value-based method. But now IFRS 2 says that we will only use fair value method for all types of share-based payments. But still, it has provided two alternative models to measure the fair value of the share-based payments. The first model is called as the binomial model, and another model which is widely used by companies is called as the Black-Scholes option pricing model. Binomial model uses a tree diagram to determine the fair value of the share-based payments, whereas the Black-Scholes model determines the fair value on the basis of certain assumptions such as risk-free interest rate, expected volatility of the underlying share, and expected life of the option. So according to IFRS 2, all share-based transactions must be measured at fair value. As discussed, there are two methods to determine the fair value. One is binomial, and another one is Black-Scholes option pricing model. Now if the Black-Scholes model is not appropriate, then we will use the binomial method, coming to the recognition of share-based payments. All share-based payments, whether they are classified as equity or liability, initially recognized in profit or loss. Now later, with the lapse of time, the liability component will be transferred to equity under the heading Share-Based Payment Reserve. Then, after fulfilling the vesting conditions, the amount recognized in the Share-Based Payment Reserve is transferred to share capital account. Moving on to the accounting entries for share-based payments, when the entity receives the goods or services from the employee, he recognizes a liability and makes the journal entry like this. Here, the amount represents the fair value of the goods or services received. The credit is made to the share-based payment liability account, which is a liability account, and debit is made to the expense account. This is just an example. You can have different accounts over here depending upon what you are receiving, whether it is property, plant and equipment, or inventory, or services. So accordingly, you will make the journal entry. Okay, so this is just a simple journal entry which we make when we receive the goods or services. Then, as the vesting period expires, we transfer the liability component to equity. For this, we will make the following journal entry. Here we are transferring the balance in share-based payment liability account to share-based payment reserve account, which is an equity account. Next, after the vesting period gets over and the employees become absolutely entitled to the shares, the entire amount in the share-based payment reserve is transferred to share capital account, and the journal entry for this is like this. Here, the entire balance in the share-based payment reserve account is transferred to share capital account. Now, let's take an example of ABC Limited to understand how to account for share-based payments. Here the journal entries will be very simple because we are using Black-Scholes model. Alright, so let me explain you the facts. The facts are that on the 1st of January 2022, ABC Limited granted share options to its employees under which 1,000 options were granted each to 100 employees. Each share option entitles the holder to acquire one ordinary share of ABC Limited at an exercise price of 10 per share. The options become exercisable after 2 years, and expire after 5 years from the date of grant. On grant date, the fair value of the options was estimated to be 4 per option, and the fair value was measured using the Black-Scholes option pricing model. The risk-free interest rate was 3%. Expected volatility of the underlying share was 70%, and expected life of the option was 3.26 years. So here, first thing you will notice is that since we are using Black-Scholes model, the fair value of the share option will be same for both employer and employee. That is 4 per option. Because if it is same for the employer, then why should it be different for the employee? Right. So that the reason the fair value of the share option granted to the employee is also 4 per option. So first of all, we need to calculate the total fair value of the share options granted to all the employees. So here the total number of share options granted to all the employees is 1,000 into 100, that is 100,000. And the fair value of each share option is 4. So total fair value will be 4 into 100,000, that is 400,000. Now this is the total fair value for all the employees. Since we are accounting for each employee individually, we need to divide this amount by 100. So the fair value of the share options granted to each employee is 400,000. 100, that is 4,000. Now the next question is, what is the total expense recognized by the company? So here, the total expense recognized by the company is also 400,000. And the reason is that when the company grants share options to its employees, it recognizes the expense over the vesting period. Now this is the total expense. Later, with the lapse of time, the liability component will be transferred to equity. So we will see the journal entries for that as well. Okay, so let's go ahead and make the journal entries now. Alright, so the first journal entry we need to make is on the 1st of January 2022, that is on the grant date when the company received the service from the employees. So here, on the 1st of January 2022, the company received the service from the employees and the fair value of that service is 4,000. So the journal entry is like this. Debit salary expense account with 4,000 and credit share-based payment liability account with 4,000. Next, we need to make a journal entry on the 31st of December. That is after the expiry of the vesting period. So here on the 31st of December, the liability component of the share-based payment needs to be transferred to equity. So the journal entry for this is like this. We will debit share-based payment liability account with 4,000 and credit share-based payment reserve account with 4,000. And the last journal entry will be made on the date when the employees become absolutely entitled to the shares. Let's say that date is the 31st of December 2026. So here on the 31st of December 2026, the entire amount in the share-based payment reserve is transferred to share capital account. So journal entry for this is like this. We will debit share-based payment reserve account with 4,000 and credit share capital account with 4,000. So, these are the journal entries for share-based payments.